I'm here today with JC Peretz from All Star Charts. JC, thanks for being here.
Yeah, sure. Anytime.
So now we're going to figure out what the hell do you know about publishing?
Very little. I'm learning. I've learned a lot. Let's just say that. But I'm learning every day. You know, I fell into this business, kind of by accident, right?
Well, let's talk about that because I like you had a very unique path, and you built your business off of social to begin with, which is a thing that a lot of publishers, like whenever they try social, no matter what kind of following they get, they can never make it work. And so let's talk about that. Like first, how did you get into it? And then I want to get kind of your take on like kind of where we've been the last 2 years and where we are right now. And, so how the hell did you get into publishing to begin with?
By accident. I didn't even know it was a thing, right? So back in the day, you know, after the great financial crisis was really like the genesis of financial Twitter and blogs. And, you know, that was really it. Before that, there was like a few, there was like Barry Ritholtz, Zero Hedge, Business Insider was doing some stuff, and like, that's it. So like blogs weren't a thing yet. And then once the great financial crisis came, a lot of investors and traders finally realized we don't need to necessarily go to traditional media where a journalist that comes from True TV or just out of journalism school that's just obviously not familiar with trading or investing, how could she or how could he, right? These are journalist majors or whatever, which is great. How are they going to know about the market? They ask the investors, they ask the traders, famous traders, hedge fund managers, sell side analysts, et cetera. And then they report that to the public. Now, there's a lot of misinterpretations there. There's a lack of explaining the time horizon in question. There's a lot of, looking for headlines, looking for little snippets that are going to get people's attention. And they completely missed the great financial crisis. Quite the opposite. They were prancing around these CEOs, every single day. So it's like, okay, they're obviously not trustworthy. The banks themselves, the sell side themselves, their track record is evidence in and of itself. They obviously completely missed it. They caused the whole damn thing. So why on earth would we listen to them anymore? I'm not just me in particular, but this is sort of the new mentality. Like those who hadn't figured that out were finally able to figure it out. And you could go directly to the source. If you want to know, if you want to understand what's going on in the Federal Reserve and monetary policy and all of these things, go to the guy who used to work at, right? Like you could go straight to the source. You don't need a 26-year-old journalist interpreting what that particular person said and maybe reporting that correctly and probably not, right? Mm-hmm. You just go straight to the source. And that was the case in technical analysis. It was the case in deep value. It was the case in, in every, all kinds of trading and methods and you name it, everything under the sun, ultimately, right? But it started with a select few, who we call them the blog fathers, right?
Yeah. So which I want to get to the blog fathers, but like basically it was a watershed event for people who don't like, because you had like basically the crisis happened within, it was like, I don't think the iPhone was even 12 months old at that point.
Right.
Because that was 2007.
That sounds right.
And so you have we had the blog, like the SEO, Google, pay-per-click, display channel, like we had the growth of the internet. And it was like the blog was the thing. And then the phone comes out, the iPhone comes out. The financial crash. You've got like the explosion of Facebook and Twitter and like all that promise of the internet kind of like removing the middleman is what you're just talking about. Happens, right. Not for everybody because you have to be involved, you have to be active, but you can go to Twitter and you can just get in. And it was an amazing like cultural shift and business shift that happens in the wake of all that trauma from the financial crisis. And then, like you said, though, there were the blog fathers. So who were the blog fathers?
I mean, for me, it was Barry Ritholtz. That's just selfishly for me. Like I'm friends with him now. I talk to him like almost every day now about markets and stuff. But like back then I was just a super fan, like I would read his blog every day. He was really good during the financial crisis. He was writing his book, Bailout Nation, which is very good. If you're, maybe new to the market and you don't really understand what happened there, his book is very good. He was actually writing in real time and would share the chapters and things like that on the blog. So that was really, really helpful at the time where we were managing money in that environment. So that was just, tremendous for me. And then ultimately, Barry partnered up with another good friend of mine, Josh Brown, So that we know Barry that way. And now they manage like $3 billion over at Ritholtz Wealth Management. So Barry for sure. Howard Lindzon, he was the founder of StockTwits. He's a venture capital investor, angel investor, and like Robinhood and a whole bunch of other companies. He's a good friend of mine. Dr. Phil Pearlman, ultimately came, he wasn't like maybe in 05 and 06, like maybe someone like Eddie Elfenbein over at Crossing Wall Street. But Phil Pearlman was early on the scene as well, one of the early employees at StockTwits, one of the early co-founders. And, all of them were very instrumental in me starting a blog because these were just my friends at the time. Josh Brown had his blog, Pearlman had his blog, Lindzon had his blog, others. So like, JC, why don't you have a blog? I'm like, I don't know. I don't know how to do that.
What were you doing at the time before you started publishing?
So I was doing a whole bunch of stuff. So I was doing sell-side analysis. I was a retail broker. I was doing private equity deals. Like we were getting shares of Facebook, pre-IPO, things like that from the private markets, bring them to investors, dabbled a little bit in insurance and didn't like it. Like I was trying a lot of different things. I started a hedge fund. I was managing that for a couple of years, trying to get that off the ground. And that's really how I got into the publishing business, to be perfectly honest, because I had a blog since 2011 because I was on Wall Street, and the compliance issues. It took me a little bit longer than some of the others to be able to start my blog. Ultimately, I did in March of 2011. So that was, 12 and a half years ago, which is crazy to think about. And then we had, the growth just grew from there, just organically on the blog and on Twitter. So we turned the switch with a paid product just because I was managing a hedge fund. This is 2012. I was managing a hedge fund, a general partner, office on Fifth Avenue, lawyer expenses. I mean, just super expensive. And I'm in my late 20s. I'm 29 years old or something like that. So in order to supplement the income that I'm making, because everybody was making money. The investors are making money. The lawyers are making a fortune. The fund administrators are making money. The brokers are making, everybody but JC is making money. But I get it. Like you don't make the money as the GP until you get much bigger. Listen, I get it. I knew what I signed up for. I didn't have to be happy about it. Right. So I had these guys over at Benzinga, Jason Raznick, who I know and there were a couple other fellas that worked with them at the time. And they were always in New York City at the time because it's New York City, financial capital of the world. They're running a financial fintech stuff and everything. So they were always in town. We were always drinking beers and stuff. And, they started this back end thing called MarketFi, where you provide them with sort of information and research that I was doing anyway as a portfolio manager at the time. So I'm like, all right, go ahead, sell it. If you can't sell any, I still have to do the work. So I'm okay with that. And then if you sell some and I make a couple extra bucks, good, because I can use it because I got all these expenses over here. So knock yourselves out. And what do you know? We started making some serious bucks. And so I started my own. I did it internally instead of outsourcing it to Benzinga. And that was in 2000. And that was at the end of 2015. So we turned a switch as we walked into 2016. And it still took me another year and a half to finally even understand that financial publishing is even an industry. And I started going to your events and meeting, all sorts of folks that run massive publishing companies. And I had no idea. Normal people don't know these things. You know that, right? Like, I
mean, people who came into the industry, even where you did, don't realize that like when I first had the idea for the event for FMS and whatever we called it in the beginning, like I was in this weird position in that I came up under a great copywriter, Clayton Makepeace, who had worked for Weiss and introduced me to kind of the Agora newsletter world. And then I went freelance and went working for like the affiliate trading education space. And those two worlds had no idea the other one existed. And so the original idea for the event was like, why don't we do something where we just put everybody together and see what happens? And so trader education and newsletters come together and trade, and like that was like a really explosive kind of thing. But that was 2013, 14. It was very new. So like just like people in basically the same industry didn't know the rest of the industry existed at the time.
I see it. I have a front row seat, John. I have a front row seat because my background comes from more traditional, non-publishing, non-retail publishing, right? Because I'm friends with a lot of sell-side analysts that publish work to institutions. So it's not completely foreign, but that's a completely different model than what's happening in a lot of retail publishing businesses, right? So again, like you're just saying, one doesn't know that the other one exists. The retail publishing business does know that the other one exists, but the actual the editors themselves, the gurus, to put it in marketing parlance, right, don't understand that there's this massive infrastructure of video talent, copywriters, digital marketers, designers. I mean, the list goes on and on and on, to be able to successfully scale a good product. You can have the greatest product in the world, and I have good friends that try to get in the publishing business that don't know that the publishing business is a business and don't know how it works. And they're like, oh, JC makes all this money because he has a big Twitter following. It's like, no, you idiots. It has nothing to do with Twitter. Though, first of all, those are all bots, right? However many followers I have, how many are actual human? So my Twitter following has nothing to do with it. Jay-Z, he's very obnoxious in his takes. Yeah, well, that's just more of the reason. The reason we're able to make money consistently year over year is because we finally figured out that the emailing people good content and getting people used to just receiving quality content that's going to make them better investors. When you ask them in return to pay up for more access to what we're doing, you'll find that a lot of them are going to be willing to do so. Yeah. Many won't, most won't, but some will. That once I figured that out, that's it. So then it just becomes a formula. The more eyeballs we get, the more people come into our ecosystem, the more they're going to like what we do and understand it adds value, and they're going to want more and they're going to buy shit.
Yeah, there is like the math component of it. It's just like eyeballs in, emails out, and then the quality of the copy is kind of your lever, the conversion. But then there's another piece there, though, that I think is like, you naturally are really good on screen. You've got a big personality. You're not a wallflower. And so like you're built, because I always think like one of the first sales that you really make is a relationship, right? And like you're authentic as shit. You don't come off as like, you're not like trying to do the I'm a news anchor thing, which is a huge mistake everybody does. I feel like when they start to get into like producing content, is they're like, I'm going to be professional. And it's like, that is not.
I'm not professional. I'm not professional.
No, you're professional, but you're not plastic. Right. And like you're a person. And like, when I watch your stuff, I'm like, I feel like I know JC from that. I knew you already, but like, your personality comes through really well. You don't have a problem like telling jokes in the middle of your analysis. You're funny, you're interesting, you're not scared of pissing somebody off. And like that authenticity combined, and this is the thing, it's like combined with good business practices is really powerful, and a good product, great product. Because I see this all the time with like people come into the industry for the first time, and like, I know it's a cycle. I can watch it. I've seen it happen so many times, and they start off and they're like, I'm from actual Wall Street. I know what the real product is. Everybody else's product is garbage. If Agora makes $1 billion, I'm going to make 10 because my product is so good. And you're like, okay. And I know at this point you can't say anything to them other than, there's a lot more to the business than just the product. And what customers think is a good product and what you think is a good product isn't always the same thing. But we can't have that conversation for minimum a year, usually 2. And I've seen it enough that it's just like,
because they have to learn the hard way. You mean?
Right. Yeah. They've got to basically fail for 2 years straight to get to the point of humility where you're like, maybe I don't know what I'm doing. And then they come and then they're like, okay, well, how do I do this? And then all of a sudden, all this stuff that was already there seems much more interesting and understandable. And like, but there's some people who are still like, my product is the best in the world. It should be. It's a couple of things, and everything you're saying, and I see it. I see these sell side analysts that are all, they've all been going out of business because that business doesn't exist anymore. Mm-hmm. And it's not like it's a surprise. Like, we've known for 20 years that business is over. Like, if you're still in that business, like,
I don't want to hear any complaining. Like the writing's been on the wall for a long time that the sell side analysis business that's just a shitty business. Like you don't want to be like, this is not a good business anyway. And there just aren't any sell side analysts anymore. Like, right. It's over. Right. So been over. So when you have like, somebody who thinks they used to be a big deal, they were a big name because they were the chief technical strategist at Wells Fargo in 1992. Like nobody gives a shit that you were whatever you think. So they think that like Wall Street owes them something, right? Yeah. So they're like, like, oh, I'm this guy because I did all these things. So all these people should pay for all this. No one's going to pay for it. Nobody knows who you are. Nobody cares, right? So you need the infrastructure in place, because if you are as good as you think you are, and you are going to put out the product, you need the people in place to be able to distribute that in an efficient manner to turn that great work into profits, right? Mm-hmm. And I think that what you just said, 1 to 2 years to finally figure it out, because that you've seen the cycle so many times. Now that you mention it, as many times I've seen the cycle, that's probably right. That's probably right. Yep.
Yeah, it's just human nature. It's like the sell side analyst is such an interesting thing too, because that whole kind of institutional analyst world imploded a bit when the soft dollars went away with MiFID.
Yep.
And like they
realized even before that, right? But yeah,
it was already, it was going out. But the thing is like that was soft dollars is the only thing keeping it going, because like people didn't really want it. It was a tool that people were using, but like for a lot of them, like they were
in the old days. Well, to your point, to our earlier point, John, in the old days, they would do brokerage business for the information, the intel, the analysts that they had on those teams. Now they could just go to the blog, right? And pay for the publishing service. Like a lot of our business comes from traders at hedge funds, financial advisors. Like we have a ton of our audience is professional. These people used to pay, because remember, the financial advisor, they used to be at Morgan Stanley. They used to have all these technical analysts. Now doesn't have that. So now they're at LPL I guess LPL has some research too. But like, let's say they're whatever own shop that doesn't have the research. They have a better payout. They need to outsource that research, just like they'll outsource the compliance, for example, and outsource maybe technology or whatever it is. So now they have more options. In the 90s, Merrill Lynch had 26 technical analysts. Today, they have 2. And they're both of them are friends of mine. They're good dudes, right? They're great analysts. But the point is that there's 2 jobs now. There used to be 26 at that firm, right? So times have changed. Times changed a long time ago. Mm-hmm. Some people have either changed with the times or kind of stayed behind, hoping that things go back to the way they were. I see that every day. And remember, I hang out with a lot of like, old timers that, were a big deal in the 80s and the 90s and are trying to sort of rejuvenate their careers, and they're having a really, really difficult time.
Yeah, no, I know. I almost feel like as soon as I hear somebody say, I used to write a note, I was like, oh, I know what you used to do. That's what you were, and now you're used to talking to people who knew what the hell they were talking about all the time. You had like you're writing to some of the most sophisticated investors, and you don't know how to write to somebody who's not. And even then, I remember when I was helping Real Vision with a lot of they had that think tank with lots of the institutional guys who were writing stuff. They were writing stuff, and you put it into the Flesch Kincaid grading thing, and it's like this is written at grade level 27, and you're like, no wonder, like you're making this as complicated as possible. A single sentence is this long, and your whole point is like you want them to think that there's something smart here that they can't understand, and so they need you.
Yeah, but you want to know something. The truth is, the truth is that a lot of these notes used to be written in a complicated way to incentivize the audience to call in to ask questions, because if they call in and ask questions, they're going to get the order, right? They're going to get the trade. So a lot of that was manipulation in order for them to pick up the phone and ask questions and get the order. So a lot of that is just built into the framework of the business, and one of the many reasons why it's difficult to go from one to the other overnight.
Right. Yeah. And then even people who were at like WoodMac, like Matt Warder talking about this, like when he went from WoodMac or Wood Mackenzie, which anyone who doesn't know is, of the commodities research analysts, like they're like one of the, like they're biased, they're independent theoretically. So like they're great. And so they're not a broker. So they're not trying to get a phone call necessarily. They're a subscription, right? It's high-end subscription. But when he went to Money Map, he had to work really, with Bill Padalon to be able to write in a way that like someone from retail, like in publishing, could understand and get and be interested in. And it takes like training to make that transition.
Yeah.
I think video makes it easier if you have a good personality. You do a ton of video, right?
Yeah. I mean, listen, we try to do more of the things that are working, and, you know, the things, you know, buying, you know, going, we've never been able to successfully go out and buy media and put together a funnel that works. If you're out there listening and you want to help me put together a funnel that works, you know, that can convert, I'm all ears. We've never been able to do it. For us, it's always been the more videos and blog posts and podcasts that we publish, the more eyeballs are going to come in, the more people are going to sign up for the free stuff. And the more of those, the more people stick around and they want to buy things. Like, they like what we bring to the table. And, you know, what I've noticed also is when we get in front of other audiences, like more like schlocky, like publishers that, you know, use a lot of hyperbole and overpromise and consistently underdeliver. And it's just, you know, oh my God, 20,000% in options and the market's not even open today. Like, just ridiculous things. And then it's impossible for them to deliver on that messaging, right? Mm-hmm. When we get in front of those audiences, we crush, right? Because their heads are exploding, because they've never received so much value, because they're used to a team of financial marketers that then takes a human and plugs them into the machine and turns them out to be this, you know, legend of some kind and everything like that. It's impossible for that poor guy to deliver on that messaging. For us, they don't know, you know, who we are, what we're all about. And we come in just swinging, guns blazing, just hitting them in the face one after the other, with one great chart after the other, you know, great value add. And they're just like, oh my God, you know. So we have found that when we get in front of the and at the end of the day, it really turns into the larger the financial publisher that we get in front of, the better, more success we have.
Yeah. Well, I mean, that's the thing, is like, there's the business of acquiring names. There's the business of selling publications. There is the business of actually trading and investing. And it's hard for any one business to always have all of those things together.
Yeah.
Because they're all very sophisticated skill sets. And and I do think that one of the nice things about the industry over the last 25 years, as you watch, like, there has been an increasing sophistication of the gurus. One of the things I think that in the boom period is really difficult, though, to maintain the quality of the guru, is because but once you're scaled up, you have to capture as much. The point of being scaled up is you can capture as much of those boom times as possible, right? And so in order to fully do that, you have to add product like crazy. And so everyone's staffed up, and the bigger you were, the more you staffed up. And you start throwing other gurus in there who, like, okay, we can sell this and make all this money. And then when everything kind of stops, they have massive layoffs, because this was essentially a balloon period. You know, they cut tons of products, and then they're back down to their core guys. And some of them are really good. Some of them are okay. And there's plenty of people in the industry who you're like, how are you even a guru? And that's, you know, that brings up all kinds of ethical issues and questions for not for everybody.
That's up to the marketer. It's up to both sides, right? So
right.
A lot of the gurus, the best gurus, if you will, don't even know that the industry even exists, right? So you need to know that going in. And if you are a copywriter, if you are a digital marketer, if you are in the infrastructure of financial publishing and you're not the guru, you need to understand that you need to find the right guru. Otherwise, you're setting yourself up for failure, right? You need the right person, the right girl, the right guy who can really both deliver in terms of the quality of the product, but also understand that there's this massive business that's necessary in order for them to succeed. And they're not going to get 90% of the revenues, right? And, you know, like, you have to understand that you're just a piece of the puzzle. Right. And it's hard for them to know that, which is why it's the responsibility of the marketers and the copywriters to find somebody who not only is great, but also understands, because you can't fault them for not knowing. They don't know. So we don't have to sit here and pretend that they do. Right. I didn't. And I know all of them. They don't know. Right. So trust me. And then it's up to if you are such a great options trader, from Chicago, or you are right, or you're like this, day trader. Like if that's great, true, that is fantastic. And if, there's nothing wrong with supplementing your income, publishing work that you're doing anyway. Like people are always like, oh, JC, if you're so good and you have all this money, like, why do you need to do this? Are you kidding me? Like the amount of, first of all, just writing every day and producing content helps me organize my thoughts about the market in a way that nothing else I do does, right?
Mm-hmm.
I would do it for free. People pay me millions of dollars to do something that I would do for free. That is just, I win more than setup. It's the truth. It's a can't lose. So like people, the only people that are like, oh, you have to sell a subscription because you can't make enough money trading. Like you're an idiot. Like you are so foolish, because not only am I making money to do something that I'm doing anyway, but also the community that you build, because it sets the difference people apart from the people that are willing to pay for your product versus just all the other, nonsense, right? Just noise. Mm-hmm. And then those people are your core audience and they become your friends. They become your mentors. Right now, as we speak, Steve Straza and Sean McLaughlin, who's our chief option strategist, Sean, and our director of research, Steve Straza, is with our video crew right now with Jim Rogers in Singapore. They're going to 8 different cities: Singapore, Kuala Lumpur, Hong Kong, Taipei, Manila, Tokyo, Bangkok, and Ho Chi Minh. 8 cities in 21 days, meeting with traders and investors. And guess what? These are our clients. These are our friends. We have a sponsor that's paying for the whole trip. And guess what? None of that would be possible if we didn't have a hardcore community that was paying us for many years, that understood us, that became family, and we continue to reap the rewards, man. It's so awesome.
Okay, so I want to talk about this a little bit more in depth, in the sense that, so like you made the comment about like, how many bots there are in social following, and it is. It's like everyone knows there's huge bots, and you're not building your business off of that Twitter audience necessarily. Where do you? So let me frame this a little bit different. There's 2 ways to approach any social platform. One is as a content creator, and one is as an advertiser. Our industry, by and large, succeeds as an advertiser. Very rarely do we have people who succeed as a content creator and advertiser. Tim Sykes did a great job. I think he was one of those early guys in Twitter. He built a big following then, and he knows how to kind of like play it up, and then they built a big business. But where do you think Twitter fits inside your business model then? Because there is a community there. They're coming from, you do have real people that you're engaging with. There are a ton of bots. I'm sure you got customers from there. But it's not like a scaled marketing plan to go after it. So how do you think of like Twitter in particular, since I know that's a strong channel for you, or you're active on it? How do you think of that?
Yeah, I mean, I don't overthink it. Is really what it is. It's always been a place where I go to learn, and to meet people, and to share thoughts, right? It's just kind of thinking out loud. This is what I'm thinking this morning. I'm thinking that interest rates are keep going up, and twos are making new highs, and that's really interesting considering what we've been seeing in tech stocks. Who's got it right? The bond market. It's just what I'm thinking about, right? So I don't have to like overthink what I'm literally just thinking about, and I kind of just type it out, laying on the couch or whatever. So that's how I use it from a distribution standpoint. If we write a cool blog post, or if I'm on TV, or we got just link it, share it with the people, right? In terms of like a strategy in order to profit from that audience, I think that we've done a really good job of staying away from selling things on Twitter. It doesn't work. It's just, it's cheap, like it's like a cheap trick. People are on your Twitter feed and you're like, oh, buy my shit. Like that just doesn't fly in that particular, that might fly like maybe an email and other stuff, but it doesn't fly on Twitter. So I think that what we've done a good job of is using it to link to content that we provide that has a CTA on that content, right?
Right. So, that's the strategy. It's not a place for broadcasting sales messages. Half of Twitter's culture is shit posting, which is what makes it so good, is like the snarkiness.
And I think it's the lack of authenticity, really, and a lot of the people who try to create a marketing strategy. Like it's very obvious that it's not authentic. People on Twitter, I think, are more aware of that. So when you have sort of somebody else doing it for you, like that whole thing, like just doesn't work. Like just go do something else.
That's where I remember Tim Seiss and Gary Vee had said, basically when they were coming up in there, they just replied to everybody's DM personally. Like they just they worked it so many hours a day to make it like kind of a thing, that you couldn't have somebody outsource, because it was like them actually responding. And you can tell, like, maybe AI, people are going to try that. We know we're going to have the AI DM kind of boom. People are going to try, because everyone tries to use every marketing tech, every black hat kind of personality decides they're going to try and like make this work for them. But that authenticity piece has been really hard, I think.
When is AI going to create a guru who doesn't suck, and then the marketers can just go to work because the guru will do wwhatever the marketers tell them to do, right? They don't need to do it.
People are trying that now, like, because you can take synesthesia and create, like, train it on you.
Yeah.
There's going to be scammers who are going to take your videos, create versions of you, have you say whatever you want and put it out there. And we're going to have to all start figuring out, like, was this a real video or not a real video? And like, it's going to create, like, I mean, this is like 10 years of problems that are coming up or more that we're all going to have. But like, that's interesting. So, because I think of like Twitter as,
can we just go back to mailing them out?
Oh, I think direct mail would work like gangbusters right now if there was a list universe enough of it. I think like with one of those things called this QR codes. Yeah, I mean, just an old QR codes. I mean, but even like the old school mail, like just with a QR code for call to action or postcards, send in. There's no competition in the mail. Like if you get it, we're back in an environment where, like, if you sent me a letter personally, JC, sorry, it would be an event for me. Like, you know what I mean? As a friend, like if you sent me a letter and there was like, it would be an event. I'd be like, what the fuck is JC sending me this for? Like it would stand out, right? And so, like, if you have a relationship with someone online and they send you something in the mail, they're like, the attention, like if we're fighting for attention, right? That's going to stand out. And if you inflation adjusted, I've talked to a bunch of direct mail guys at this point about this question. Like, what was the cost to acquire a customer back in the 90s in the mail? And you were looking at $130 to $150 to acquire a customer. Inflation, like, we were up to 300 here for a while. Like the cost advantage of the internet, like right now, and it changes every time there's a new kind of meta platform or whatever, is back to where it is. And so I have a friend he does a lot of consulting with like the Fortune 500, and like they opened up a new consumer brands division. And they were saying that they're finding all these small brands coming up. They get to about $50 million using like Facebook and other things, like Warby Parker, right, for glasses. And then they find that it's actually cheaper for the consumer brand to start opening up storefronts to acquire customers than it is to keep advertising. Amazing. And that is crazy.
Yeah, it's like it's become the reverse now. Now you're using that to bring them in.
Right. And so, like, for me, and I have only anecdotal evidence at this point, but I do think that the mail, at least on the back end, is probably a really, really underdeveloped channel for most people. And we're also the level of creativity that people who are doing mail right now is probably much lower than it could be. Like, you should be going back to Dan Kennedy's trash can mailers and stuff. You could probably do some cool stuff. Sorry, so you started with you're just posting content and getting customers in, and you're doing it on Twitter. You're doing it on YouTube. Do you do any other channels?
No, it's mostly just Twitter and YouTube, and that not because we were so smart or anything like that. That was just kind of what I understood the most, what made the most sense to me. Facebook is for the way I learned it, because it's interesting, like all of our generations, we might be, 3 years apart, 5 years apart, 10 years apart, 15 years apart. But in terms of where you fit in that social ecosystem, it's actually a dramatic difference, those years. So Facebook, for example, came out as I was graduating college. So the only reason people had them, like my friends were getting them to pick up girls and stuff, but I had a girlfriend. So the last thing that I wanted was for like old girlfriends to find me on the internet. Like I was like, no way do I want that. So I didn't sign up for Facebook. And then all of a sudden, all I would hear is horror stories, one bad thing after the other. I'm like, I'm not doing that. And then ultimately you find out that all these divorces like include Facebook and like the proceedings and all these things. Like I was like, I saw it early, so I never had a Facebook account. So Twitter for me really made a lot of sense early on. And YouTube. And then as it turns out, YouTube is really where you want to be, it's like 30-40% of where people get their financial information is on YouTube. Like I keep seeing a lot of these polls, like that's the number 30 to 40. Like you want to go where the people are, no?
Right. Yeah. And it's interesting too, because search is still huge, even though it's not sexy. Search in YouTube is, the second largest search engine. Or is it the largest at this point? I forget. It's up to either Google or, and so like, I think as a platform for marketers, YouTube has kind of maintained a very unique spot because it's like the long form content, even if it's just 10 minutes relative to some of the short form stuff, like people like the algorithms love, and it's easy to scroll short form content, but like, I don't know about you, but everyone I buy off long form content. I build a relationship with someone.
You bring up a good point, because here's the difference in the types of businesses. A lot of the YouTube content is ad revenue driven, right? Like you produce a lot of content, the more eyeballs, the better, the more money you're going to make in ads. But because we're not in the ad business, we're in the publishing business, it's a much better margin business. It's a much more scalable business. So we don't need as many eyeballs. Mm-hmm. It's more about getting the right eyeballs. It's about getting the right people to watch. That's really what it's all about, not the most amount of people. So when we go into, our production, we understand what the end game is. It's not that we don't want more people to watch, but we're more interested in the fact that we want the right people to watch. And that's where Facebook and Twitter comes in as well. The way I learned it was that Facebook is for the people that that you have nothing in common with. And then Twitter is for the people who you don't know, who you have a lot in common with, right? That's so good. We kind of go there.
Yeah, no, that's good, because it is like very topic. Like you said, there's finance Twitter, there's whatever Twitter, there's
sports, and
whatever you're interested in, you'll find a community.
There's no FinPub Twitter though.
I know, I've debated, but I'm like, if I start getting into Twitter, like it sucks so much of your time. It's like, how many things do you commit to?
It's such a small industry though, and so like it's so tight knit community that it's just not big enough. Right. You got Baltimore and like London and maybe Austin or something, and like nobody else knows that it even exists, right?
Yeah, for sure. But it is a great place to go to understand what the story is right now on anything. Like you can see what the conversation is. But
the conversations are not about financial publishing. The conversations are about what's going in the market that financial publishers are going. Yes.
Yeah, for sure. But like, it's definitely an interesting thing. So you guys haven't like done a lot. You said a lot of external, but you've got, so like, it's interesting because I feel like you got to a pretty good size for basically doing a creator strategy in FinPub. And I think
we got to about 4 million or something like that in ARR
without external media buying.
0.
And like, that's really impressive. Even with the boom we had, like, because
but it went through the boom. So we were acquired in March of 21, and we were still on the rise, and then working for Tiffin, they have different objectives with their, speaking of AI and, the fintech stuff that they're doing, that just growing their financial publishing business, which is what we were doing before we were acquired, was just not a priority for them. They're doing other things.
Yeah, and that's a whole other angle of this to explore, but the Tiffin and the AI piece. But I still think that like getting to 4 million based on content, like you did organically, is a very rare thing in our industry. It's a very rare thing. Most people who push up to the $4 or $5 million range do it based on a really large funnel, a really strong funnel, and a really strong media channel for a while. And they just beat it to death. And then it's not sustainable because it's one funnel, one media thing. but they got it to work for a long period of time. That kind of the economics change. It doesn't work anymore. They drop back down to 1 million. Like that's another one of those repeating patterns in the space. Like the 4 to 5 million mark based on paid is a really hard barrier for people to break through. And you can see like there's very few companies that get up there. And I've heard of nobody else that I can think of who did it organically. And that is very, very impressive to me. And that's what, when I think about like audience and social, like the fact that you're able to do that, impresses the hell out of me. And it's one of the things that makes me think more about like the content strategy on those channels. And I was wondering if part of it is something that you said earlier. You have a lot of B2B folks on there. You have a lot of professional, you have RAs, you have hedge fund managers, I'm sure family offices, like you have like a more sophisticated customer base, at least as a segment of your audience, right?
Yeah.
And so your LTVs, I mean, you don't have to share if you don't want to, but like they've got to be pretty good on the customers that you're getting.
Yeah, I think our LTVs before we were acquired were up to maybe like 2,800. We're doing close to 4 million on like only a list of like 40,000 people.
That's awesome. Yeah, that's fantastic. So yeah,
we were never even able to grow our list. We would grow our list or just organically. I'd give presentations and just be like, hey, if you want the slides, email me here, and we add them to the list like that and stuff like that.
Wow. So like that's like 40,000. So to me, that is like 40,000 like hyper engaged names then. At $2,800 LTV.
Yeah, big open rates. I think probably like 30% open rates pretty consistently. And then some of our free e-letters, seriously. So our bigger list open rates were probably like 30%. And then some of our free e-letters were close to 60-70%, believe it or not, open rates on one of our free e-letters. And then on our paid fulfillment, it's up in the 70s as well.
Wow. That's fantastic. So do you think that, I mean, I would suspect that that's just because like with the organic strategy and with Twitter and the kind of stuff you're talking about, like you are attracting that higher quality customer. I do think that the advisors, and there is a professional segment on the investing side of this business that is the higher end customer. And I bet you if you go to like the Stansberry Atlas Club, which is, I think it's a $30,000, $32,000 product at this point, you're going to find like the percentage of professionals and semi-professionals in that group are way higher than,
these are CEOs of companies. They're, retired people who have done well for themselves. These are financial advisors, portfolio managers. Maybe they run family offices. I found that a lot as well. Just investors that, hit it nice early, whether they inherited it or they sold their companies, relatively young, or, just made some really good trades, hit some biotechs early, right? And now all of a sudden you got 10, $15 million and you don't need to work and you just manage that. I find that quite a bit, actually.
Yeah. So you're not getting but so part of that is you get the customer you ask for, and you're not asking for the guy who's thinking he's going to turn his $500 account into $1 million income.
That's unsustainable. All you gotta do is just piss everybody off. Like, why do you have to lie to them? Why can't you just tell them the truth? The truth is we're going to do our top-down macro approach. We're going to put the global market environment into perspective first, right? So it's not like we're going to make some, this cash flow ATM, money printing machine algorithm that I have that's just going to make money no matter what the market is doing. No. First, we're going to identify what type of market environment we're in, and then we're going to pick and choose the tools and the strategies that are best for that type of market environment, which are going to be very different than the market environment we had 2 years ago, the market environment we're likely to have 2 years from now, right? So there's a time and a place for everything. It's not buy gold forever because the world's going to come to an end. There's a time to buy gold and there's a time to not. There's a time to short everything because the market's going to crash. And there's a time where the opposite is what's happening, like in the last year. So just be honest that there's a time and a place for everything. And we're going to be navigating the markets together.
Yeah, no, I love that. And like, I think because of that, you have a better quality customer. And I think that everybody that I know who's built $100 million business, with a couple of exceptions, has said, I wish I didn't do it. Right.
Stop at 50.
Yeah, it's like the 25 to $50 million range seems to be like the sweet spot for a publishing business, because you're going to have enough of a team to do whatever you want. But once you start pushing up there, like I had one guy who, this was in an ancillary industry. He had a $200 million company, and he's like, once I got up to 150 million, most of my time was dealing with some kind of a lawsuit between employees, from employees, it was just like, there's like, sexual harassment lawsuits. You get that many people under you, and it's just like, it's an HR nightmare.
Yep.
And like, it's just, he's like, the business stopped being fun. And it's like, you can make, the margins are so good in this business, at a 25 to $50 million business. It's a great business to have, and you have enough freedom to keep doing things that are fun and interesting, and like, you can weather the storms. That's it's funny how
there's nothing wrong with a $25-50 million business with 30-40% margins. What's wrong with that?
I don't think there's anything wrong with that.
Right.
Yeah. So what are the things that, like, you did sell your business, and you're now over with Tiffin, and they do have that, you're part of they were starting to roll up publishers, and they're much more focused on a slightly different business model, a very different business model. What are you thinking about these days then, in terms of like the business and the customer base, and kind of doing what you do? Like, what are your biggest concerns these days?
Well, listen, I've learned a lot, right? So, people come to me, in terms of publishing, we sold the company. So obviously I've learned a few things throughout that process. And we had 4 or 5 different companies that were trying to acquire us. So I kind of went through that process a few times, and, I learned a lot. I learned a lot about how much it sucks, really. I mean, the M&A process is not fun, for the record. Like, obviously, you're getting a check, and, you're making the decision that's best for you and your family, and that's fine. But like, nobody says there's anything fun about it. Like, holy shit, there's so many documents. It's crazy. Anyway, God bless you. If you're an M&A lawyer, like, God bless you. Like, you can have it, right? Speaking of businesses I don't want to be a part of. So very eye-opening, a lot. Great. I also hadn't worked for a big corporation. Tiffin's almost $1 billion valuation company, right? It's almost a unicorn at the last raise. And they keep raising every time they do a round higher. And I hadn't worked at a big company since Merrill Lynch in 2003, which was 20 years ago. So, I had always been at smaller firms and everything like that. By design, I worked at Merrill Lynch, and I knew that I didn't want to work at a place like Merrill Lynch. It was just a great experience. So now I'm getting like, I'm like, wow, like, you guys really do that? Like, it's not just like on TV. Like, you guys do like, stretching exercises together and stuff, like in meetings. All right. I can get down with that. And then I did, like, it's like real, like team bonding stuff. And like, this is cool. All right. So it kind of like, just culturally, like big company stuff, like really cool to see people really working together. Like, like you say, like a family, but like, yeah, like it kind of, it's really something cool to be a part of that I hadn't been in a long time. Right. So very eye-opening there. And then just understanding the Tiffin, and by acquiring these financial publishers at much lower multiples than what you're getting for revenues in financial technology, which is 15 times the multiples that publishers revenues are getting. Understanding, and a lot of publishers, I've noticed that might be frustrated with some of the decisions Tiffin has made, and no longer working with that marketer, or no longer working with this. But I think it's important to understand that Tiffin's got different objectives, right? This is not a publishing company trying to grow their publishing business and bring on new gurus and launch funnels on this new media outlet. Like, that's the last thing that they want to do. They are interested in bringing additional value in terms of the tools of the future, right? The AI tools of the future to an investor that's never seen these things before, because they've never existed before. So it's about adding value from a technology standpoint to an audience that is there to learn about the market. Now there's additional tools that they could bring them. So it's a really interesting strategy, and it's just very different than what's going on around the industry. So I think there's a lot
of cool things that I love. A lot of things about Tiffin, and whether it works out the way that everyone hopes it will or not, who knows? Like, but one, that close to $1 billion valuation came before the AI boom. So I'm sure that they're getting an AI bump now because
it was an AI company from the start,
right from the beginning,
years ago when it was founded, right. 4 years ago, maybe more, maybe 5.
Yeah. And I love like all business, other parts of the business aside, I am still wildly enamored with kind of what you referenced, which is that they were buying publishers, which, you know, have, as everyone in publishing should know at this point, really crappy valuation multiples compared to other things, right? Like you're talking about like a couple, 2 to 4, if you're lucky, is like pretty much where like,
not 4, John.
It's not 4. I know. I was in the best of times, and I always say 4 because there's always somebody who hits me up later and is like, this is like, you know, it's 4 because it's written down somewhere. And it's like, yeah, maybe written down somewhere, but it's not written on a check.
Let me tell you something from somebody who went through this process a bunch of times. Yeah, maybe. Yeah, exactly. It ain't 4. Right.
I'm trying to be like,
sorry to be Debbie Downer over here.
But the brilliance of this to me is like, because it is you take the revenue, buy the revenue at 1.5 to 2 times and roll it into something that is getting valued at 25 times revenue and raising money like that. Like they won the minute they signed the deal, like because it's a business model arbitrage, and then the fact that like you're bringing customers in to this other kind of product line and using media that way was, you know, just like cherry on top. And so like that to me was always something that I was really impressed with in terms of just like the intelligence of the team in terms of just understanding like this difference in business
the intentions,
right. And I do think that like the AI for investing piece, like I do anticipate an AI boom, and I know some people kind of poo-poo me on this. I mean, in specifically an AI trading boom. I think that as like the language models get more and more sophisticated and they start to get access to real data, it's going to be a little bit of time here, but I do think that that's coming. And then I think that like people who, I think it's going to become part of the workflow. Now, will those replace gurus? Not necessarily, but I think that all of you guys will be using some form of probably proprietary AI. You're gonna be like, I'm gonna take this thing, I'm gonna apply it to these models that I think matter, and it's gonna allow me to do my analysis even deeper and more functional. And then that becomes part of the marketing. And so like that piece is definitely like coming to our space, and there will just be another AI tool boom.
Agreed. It's just going to make people more efficient and better at their jobs is really what it is. It's not going to replace things. It's going to make you better. It's the old thing, like, you know, the chess competitions, it was like the human, the computer, and then the human with a computer. And the human with the computer is just going to be better than the other two, right? So I think this is going to be no different.
I agree. But I think it's you know, it's definitely like, I don't know. I like talking to you about like kind of your shift on after 2008 and kind of that whole environment, because I do feel like while we do not have the same traumatic experience that we had in 2008, we are having a bit of a I don't know if it's the economic cycle, business cycle, it's a technology cycle change. Technology cycle change with the AI.
Yeah, boom. It's an evolution.
Right. And every time that kind of basic meta of tech changes, it's, trickle down economics. It changes the advertising platforms, it changes the opportunities, and it creates more and more opportunities. And so like having a little bit of an understanding of how, like, when you, like you said, they had the blog fathers, people who were using like kind of the search function and writing these long blog posts around finance. And then you have the 2008 crisis, and you have this Twitter explosion where everybody can kind of flatten the information curve and built a whole culture of people who are like talking, who are real, who were, brought in a ton of gurus into the space, increased the sophistication of our audience. Our industry as a whole grew dramatically. Yeah. And now we're kind of about to navigate another 3 to 5 years, I think, like that again. And seeing like this time, like my thoughts on it are, there are things that I did in this last cycle and these last changes that were smart. There's more things that were stupid or just that I didn't take advantage of. That, like, in retrospect, retrospect is 2020 is always hindsight, but there are repeatable patterns of how these tech cycles change. And like the signs were there, like, people who didn't get into Bitcoin, like the signs were there.
Yeah. Like
the signs were there early.
Are they still there, John? Are they still there, the signs?
I don't know. I'm just saying, I know a guy who found it at 5 cents and didn't buy it.
Well, Listen, this is really it, and this is something that I've learned from a lot of my smart friends, very successful friends, particularly successful investing friends. You just want to get your hands dirty. All right, play with the toys, play with the new toys. Whether you're gonna like the virtual reality thing, buy the damn thing and play around with it, test it out. You know, people are like, oh, cryptocurrency is criminal. It's tulip bubble, da da da. Have you used the DeFi protocols? Like, have you actually gone through the process of actually going through the DeFi protocols and then deciding this sucks and it's useless? Right. Or do you just not want to learn about it, not play around with it, and you just think you just want to hope it goes away, right? Like, is that what you think, right? You know, get your hands dirty. Like, even if you swear to God you're going to hate this thing, then definitely play around with it. It's not going to hurt you. You're going to learn something, you know, like something as simple as a cryptocurrency. You never traded cryptocurrency. Open a Coinbase account, buy the damn thing, go to Uniswap, you know, open your MetaMask wallet. You swap for a different than buy an NFT, loan out an NFT, you know, and get income, earn Ethereum by loaning that out, you know, borrow against your NFT. Right. Even if it's like an insignificant dollar amount, just go through the process. I think it would be very enlightening. And that's just one of many examples. That's AI most recently.
Yeah, that's a great example. That's great. Like, that's a great principle. I think that, like, because I think about this, like, in terms of, like, with all of these things, it's very easy to be dismissive. Because every time there's a boom, there's charlatans and there's bullshit, and it's very easy. Like, you know, remember when Buffett gives his speech to all the .com billionaires right before the crash, and he was like, you know, what did he say? He was like, you know, in the 20s, there was 3,000 car companies, and it was obvious to everybody that cars were going to replace horses. But you couldn't have picked Ford based on anything that they were going to be the one. The only thing you knew for sure was the short horses. And like, there's a fundamental truth in that. At the same time, like, the internet did change everything, and there was huge things that came up out of it. Picking which ones were going to be the winners was a lot harder than a lot of people would have liked to think at the time. Same with crypto. There was a lot of like charlatan shit that came up in the ICO boom. That doesn't mean that the whole thing is. And so I think for me, this is a lesson that I learned is like, both things can be true, and you have to remember that. Like, you can have a lot of charlatan bullshit happening, and it could be an amazing.
Well, if it by definition, if it doesn't have a bunch of charlatan bullshit, it's not good, right? Like, the charlatans are going to go to the things that are good where people are. So, you know, I would encourage you to play with the toys. I try to go out of my way to do that. I really, really do. And I've lost money buying real estate in the metaverse. And I've lost money in the, you know, other silly things that, you know, I've done and bought, you know, just to play with the toys and test out new technology. Like, yeah, I mean, it's part of it, but it's going to help you make. First of all, some of them you're actually going to make money, and in others, but more importantly than that, you're learning through the process. That's what and it's going to help you make better decisions in other things.
Yeah, fair. And so I don't want to keep you too long. I just want to close with you've been calling essentially that we've been in a bull market for a while, right? Or like that is the market's been going up,
right?
And now we see sentiment turning, and everyone's starting to realize, hey, and we're starting to see headlines again. And coincidentally, we're starting to see sales days pick up across the industry with that. Do you see that too? Like, sentiment and like investor sentiment and sales are correlated. Chris Rowe's pretty big on that, and I think there's a lot of.
I mean, for me, the way I learned it was the higher the VIX, the higher the clicks. Right. That comes from Phil Pearlman. We've actually done really well in the past when the market is sold off. We tend to be on the right side of that trade, so that probably helps. But for us, it's consistently been when the market, you know, like fourth quarter 2018 was record quarter for us in sales. You know, a COVID crash, we crushed. You know, those were record months, record quarters for us. You know, in some of the worst markets, we've done very, very well, probably for a variety of different reasons. And, you know, getting back to your early point about calling a bull market a year ago, it's because stocks stopped going down, right? So the first thing that stocks need to do before they could start to go up is they need to stop going down. And that happened in the second quarter of last year. they stopped going down. I remember thinking in June, be like, yo, you see that news and stock? Why aren't stocks down? How come stocks aren't going lower? Like I remember every day for like weeks, like, how come stocks aren't down? Like, what is going on? And then sure enough, you start seeing, 1 week highs spike, 3 week highs, 3-month highs spiking one by one by one. And it's like, not only does stocks stop going down, but now more and more of them are going up. So by the time that the S&P 500 and the Dow and the NASDAQ made their final lows in the fourth quarter of last year, there weren't any stocks left still going down. Most stocks were already going up, right? And that's the whole point. And like the problem with humans is that humans are always waiting for their stupid computers to tell them that the market's going up instead of just counting. Like, why don't you just go stock by stock and count how many are going up and how many are going down? Like, why do you need some fancy algorithm or some indicator, or whatever thing that you built in your mother's basement or whatever that's going to tell you that it's a bull market? What happened to counting? Why can't you just go count? I don't understand. I think humans are lazy. I think, they're always looking for the cheap. And by the way, it's not that it's lazy. It's that our brains are trained to find the shortcuts in life and everything like that. But in the market and portfolio, that's not where you want to do that, right? Like literally, you want to know if the market's going up, like just count the stocks. Like just go chart by chart. This one's going up. This one's going up. That one's going down. This one's going up. Oh, wow. All the technology ones are going up. The energy ones are not. All right. This is something interesting. Just count.
That's beautiful. I love that. And that's where I think, I'll leave you with that. But like just from like for everybody in the industry who's not a guru, right? The guys who are not the analysts, the copywriters and marketers, product managers and everybody, like I'd love having you kind of talk like that and explain, like think of like those things, because we all need to get, I feel like as an industry, we need to have more people in the business understand markets better, because there's more ideas, more opportunities. Like there's like, you said a bunch of things today that I think could become sales ideas, promo ideas, if you kind of digging into them, and it's market stuff that is unique to how you view the markets, that into your experience, into your relationships, into those conversations that you have, that like isn't something that is easily swipeable for somebody else. And like the more the copy and marketing teams like kind of engage on these ideas with like you and other people and their editors and gurus, like the more actual marketing ideas that are really going to resonate kind of come out, I think. And like, there's so like, I'm doing this series with Connor Lynch, we haven't released it yet, where we're actually going to start going through like kind of like why investors buy, and like going through like company stories, and like say, well, like this company is like, we get someone from the company on and be like, they're telling their company story this way. And it's like, there's like 6 things in here that I would say are more important to talk about than what you're talking about. Mostly as a copy exercise. But like we can do that with gurus and everybody else. Like I remember talking to a guy one time, and he was giving me all this stuff, and he wouldn't answer any of my direct questions. And then he like 6 or 7 conversations in, he mentions, oh, well, because I was asking about 1987 and the crash, and he's like, oh yeah, well, I was on the equities desk at Morgan Stanley, and we made like 75 million taking the other side of the trade for Soros when he asked us to take it. That was the business. And it's like, why couldn't you tell me this story when I asked if you knew anybody who was a big trader?
Right. Yeah. But they don't think that way. I didn't think that way before either. And now I think like, I think a lot differently, understanding the business. And I think that having both perspectives is obviously an advantage. I share my perspective, with the publishing industry in terms of the market, and then my market friends, I'm like, yo, there's this whole thing over there that these guys are doing that they could really help you, and you really need them. Like you really need them.
I think like from a publishing perspective, often we're led from a copy publishing perspective, and so it's always like, oh, this guru doesn't understand. And then it's like, well, the guru's got a point that like the copywriter just doesn't understand. And it's like, maybe like both sides need to understand the other side's business
maybe try to understand each other a little better.
It's a crazy idea.
Go have some drinks, go fishing, go play some tennis, go figure it out. Right. Exactly. Or maybe it's just not meant to be. And maybe you should go marry somebody else and not this one, right. So there's that also.
For sure.
There needs to be that chemistry. Yep.
Chemistry is a huge aspect, and I think it's one of the we don't talk about it because it's so hard to define, but like I know almost every copywriter I know has a guy who all of his biggest winners happened with. Like right? It was with this person, whether it was their copy chief or their or the editor. And they can never quite get that same success with anybody else. They'd be good, but there's usually like some dynamic that is at play there that is like all the winners came and they can't reproduce that magic. It's like bands, like, you know, you be in the Beatles.
I mean, listen, you need your shooting guard and you need your big center, right? Play defense down low, right? You need both.
Exactly.
Or these days, the center shoots threes also. So who the hell knows? Things are always changing and evolving, John, not just in publishing, in basketball too, you see?
That's true. It's almost like the whole world is like, you know, full of humans doing stuff and there's repeatable patterns.
Amazing.
Crazy. All right. So last thing then is you do affiliate deals with other people. You do webinars, you do stuff with other publishers. Anybody who wants to do business with you, either reach out to you at All-Star Charts, allstarcharts.com.
Yeah, email us info@allstarcharts.com. So that's info@allstarcharts.com. If you have any marketing ideas on the stuff that we discussed today, you want to work with us, we're very open-minded to working. You know, my job at Tiffin is to, you know, grow All-Star Charts. You know, just continue to do what I'm doing, help integrate with the fintech stuff. But like, if you're a marketer out there, that's not your problem, right? That's my problem. You know, we're interested in building our audience, getting a bigger audience, it's really eyeballs, because our conversions are off the charts. You know, like in terms of industry standards, like talking with a lot of people in the industry and showing the numbers, and they get into our system and they start playing around. They're like, wow. So like our conversions are off the charts. Our retention rates are off the charts. Like there's certain things that we do that are just so far from industry standard. Some of them you mentioned earlier, but when you see it in the stats, you really see it. So if you're interested in making some money, I'm pretty sure we can help you. Yeah,
that's awesome. And so anyone who needs a direct introduction and they want to hit me up, I'm happy to make it. And so thanks, JC.
You got it.
I always enjoy talking to you, and it's always fun when I see you in person.
For sure.
It'd be nice to see you in the Caymans again, but you know.
Dude, Caymans, man, it's so far. Caymans. I got 3 kids under 3, man.
I know the same. Well, actually, I'm gonna have to. I would say this. I would actually rather see you in New York. I'm actually one of the people who's not a huge fan of Grand Cayman.
Okay, we'll come to New York. Listen,
so New
York's my favorite city in the world.
Next time I'm up there, I'll hit you up.
How about a little omakase? You all right with that?
That sounds amazing. Yeah.
Done.
Do it.
Done. Omakase on me when you're in New York. Deal.
All right. Killer.
All right. All right, John. Adios.
Bye.